Support for today's episode comes from Amazon. Amazon is working toward a carbon free energy future, doing more with less, investing where it matters most, and supporting communities where we operate. Europe's utilities start owning their data centers. Iberdrola's equity stake in a Spanish data center joint venture signals a shift in how European utilities compete for AI infrastructure demand, trading land, grid connectivity, and long-term energy supply for ownership, not just another power supply contract. Iberdrola and Dublin-based Echelon Data Centers formed a joint venture last year to build and operate large-scale data centers in Spain, and the venture began commercial activity in 2026 after clearing regulatory approval. Iberdrola holds 20% of the venture through its digital infrastructure subsidiary, CPD4 Green, while Echelon holds the remaining 80% and manages development, permitting, and day-to-day operations. Iberdrola describes the venture as the largest binding agreement of its kind in Europe between an energy company and a data center developer, with more than 700 megawatts of grid connections already secured and a potential portfolio reaching 5,000 megawatts. What Iberdrola is actually trading for its stake. The venture's structure reveals what a utility now brings to a data center partnership beyond electricity itself. Iberdrola's contribution is land already connected to the grid, secured transmission capacity, and a 24/7 supply of clean power. Echelon's is the capital, permitting expertise and hyperscale customer relationships to build on it. The joint venture plans to invest more than $2 billion, approximately $2.3 billion, in Spanish data center development. The first project under the venture, a 160,000 square meter complex near Madrid called Madrid Sur, has a secured 230 megawatt grid connection for 144 megawatts of processing capacity and is expected to be operational before 2030. That exchange of land, grid connectivity, and long-term energy supply for an equity position only makes sense in a market where grid access itself has become the binding constraint on where data centers can be built, not construction cost or hyperscaler demand. Why utilities are choosing equity over power contracts. The European Data Center Association estimates European data center capacity will require 176 billion euros, approximately $206 billion, in cumulative investment from 2026 through 2031. And the traditional hub markets clustered around Frankfurt, London, Amsterdam, Paris, and Dublin have grid connection queues that can extend up to 7 to 10 years in some markets, against an 18 to 24-month data center construction window. That mismatch is pushing hyperscaler investment towards secondary markets, including Spain, where utilities that already hold grid capacity and permitted land have leverage they did not have when a power purchase agreement was the standard deal. Taking an equity stake instead of only a supply contract lets a utility capture a share of the venture's value while guaranteeing a large, stable customer for the electricity it was going to sell anyway. A structure that treats guaranteed delivery timelines as more valuable to a data center developer than the lowest available price. This is not an isolated deal. Iberdrola's arrangement is the most binding example so far, but it fits a broader pattern of European utilities and generators increasingly combining power supply with equity investments, dedicated generation, and infrastructure partnerships tied directly to data center growth. Data center operators in some cases are moving the other direction, buying generation assets outright rather than contracting for their output, which underscores how thoroughly the old model, in which utilities treated on-site and dedicated generation as a side program rather than a core strategic priority, has broken down on both sides of the transaction. What this means for companies evaluating European sites. For companies weighing where to locate AI infrastructure in Europe, Iberdrola's model suggests that the fastest path to power may increasingly run through a utility with land and capacity to trade, not a standard tariff. That shifts the site selection question from which country offers the best electricity price to which utility is willing to become a co-investor in exchange for guaranteed offtake and secured connections. Whether that model spreads beyond Spain will depend largely on how many other European utilities hold enough uncommitted grid capacity and permitted land to make the same trade, and how much of the 176 billion euros approximately $206 billion investment gap secondary markets can absorb before their own queues start to look like Frankfurt's. Sustainability Soundbites energy coverage is sponsored by Amazon. Visit the link in our show notes to learn more about Amazon's Spotlight on Energy. For sponsorship opportunities with Environment and Energy Leader, please reach out to a member of our team.